When interest rates stay high, what breaks first? Housing, stocks, or jobs high? Interest rates don't feel like a headline. They feel like friction in the monthly payment, in the credit card balance, in the loan that turns from approved to pending, in the job listing that disappears without explanation. And because the pain is distributed, people ask the wrong question. They ask, how high are rates? But the question that actually matters is, how long can rates stay high before something breaks? Because high rates are not just a price. They are a stress test, a slow motion audit of everything the economy built during the era of cheap money. This documentary is about that test. When interest rates stay high, what breaks first? Housing, stocks, or jobs? Not as an opinion, not as a prediction, as a mechanism. Because once you understand the mechanism, you don't need to guess the future. You can watch the pressure move. To understand why, start with the thing most people forget. Interest rates are not just a number set by a central bank. They are a signal that propagates through the entire system. Rates change the cost of borrowing. The cost of borrowing changes the cost of owning assets. The cost of owning assets changes behavior. Behavior changes the economy. That chain is the transmission mechanism. And the reason high rates matter so much today is simple. For more than a decade, the modern economy learned to live on low rates. Cheap money didn't just encourage borrowing. It changed what felt normal. It shaped business models. It shaped housing demand. It shaped stock market valuations. It shaped hiring behavior. So when rates rise and then stay high, the system doesn't just slow down. It has to relearn what reality costs. And relearning is rarely smooth. Now, when people say something will break, they imagine one dramatic moment, a crash, a collapse, a single day where everything turns red. Sometimes that happens. But more often, breakage begins quietly. A refinance doesn't go through. A project is delayed. A hiring plan is paused. A bank tightens standards. A consumer stops spending. No siron. Just a series of small no's that accumulate into a regime change. So the real question isn't whether high rates hurt. They do. The real question is, where do they hurt first? There are three major arenas where rates bite: housing, stocks, jobs, and they are connected. Housing is the largest leveraged asset most households will ever touch. Stocks are the most visible pricing machine in the economy, where optimism and discount rates collide. Jobs are the social layer where policy becomes personal. So if rates stay high, the system will try to shed stress, but it won't shed it evenly. It will shed it where leverage is concentrated, where cash flows are fragile, and where confidence depends on cheap funding. That's why the what breaks first question is not a guessing game. It's a balance sheet question. So let's start with housing, because housing is where high rates become a daily experience. In the low rate era, the monthly payment was the story, not the price. People didn't ask, is this home worth it? They asked, can I afford the payment? But when rates rise, the payment jumps enough to remove entire groups of buyers from the market. This is the first crack. Demand doesn't vanish because people stop wanting homes. Demand vanishes because the payment becomes irrational. So housing begins to break in a very specific way. Not always in prices at first, but in volume. Sales slow. Builders pause projects. Mortgage applications drop. Time on market lengthens. The market stops clearing at the old terms. And the longer rates stay high, the more housing becomes a two-speed world. Existing homeowners with low locked-in mortgages don't want to sell because selling means giving up a cheap loan and taking on a new expensive one. So supply tightens, but demand also tightens. Affordability collapses. While prices don't fall as much as you'd expect, the market freezes. And a frozen market is not a stable market. It's a market waiting for something to force movement, a job loss, a relocation, a variable reset, a construction slowdown that hits local income. Housing breaks for real when the freeze turns into forced selling, and forced selling happens when cash flow breaks. Which brings us to the second arena, stocks. Stocks are a pricing machine for future cash flows, and interest rates are the discount rate, the gravity that pulls valuations down. When rates are low, future cash flows are worth more today. When rates are high, the future is discounted more heavily. That's why high rates can hit the stock market even if earnings haven't collapsed yet, because the valuation math changes. In the low rate era, that math rewarded growth stories and tolerated losses. High rates reverse that. They reward cash flow today. They punish maybe later. And when that shift happens, something subtle breaks. The narrative engine, companies that relied on cheap capital suddenly have to prove profitability. Startups lose funding. Unprofitable firms downshift. Mergers slow. Buybacks become more expensive. And the market starts asking a question it avoided for years. What is real? And what was subsidized by the cost of money? This is why high rates can create fragility without a single catastrophic event, because the market becomes sensitive. Small disappointments become sharp. Debt maturities matter more, and duration becomes a risk factor. Now pausieti, because the pattern is clear. Housing breaks through payments and leverage. Stocks break through valuation and refinancing. And jobs break last until they don't, because the labor market is usually the lagging indicator. Companies don't lay people off the moment rates rise. They wait, they cut budgets, they freeze hiring, they delay expansions, and only when those moves aren't enough do layoffs begin. That's why the most dangerous phase of rates staying high is not the first month. It's the 6th month, the 9th month, the 12th month, because that's when slow friction becomes a cash flow problem, and cash flow problems become staffing decisions. Now, before we go deeper, if you want more documentaries that explain the hidden mechanics behind money, markets, and power, subscribe now. This channel is built for long-form system stories like this, because the next part is where we answer the central question: what breaks first, and what breaks next? To answer that, we need to understand the 3 pathways rates use to transmit pain. Pathway 1. When rates rise, new borrowing becomes expensive. But the deeper consequence is that the economy loses its easy restart. Borrowers who could survive by rolling debt now face a wall. And walls create defaults. Defaults don't need to be massive to matter. They only need to be concentrated in the wrong places in credit-sensitive sectors. Pathway to the asset holder. High rates reprice assets, homes, stocks, bonds. That repricing changes behavior. If home equity stops rising, people feel poorer. If portfolios stagnate, spending cools. This wealth effect is one of the quietest ways high rates hit the real economy. Pathway 3. The employer. When borrowing is expensive and demand cools, businesses become conservative. They protect cash. They reduce risk, and the first form of reduced risk is hiring. The second is investment. The third is layoffs. So the employment effect arrives later, but when it arrives, it accelerates. Now, here's where most analyzes fail. They treat housing, stocks, and jobs as separate stories, but in a high-rate regime, they behave like a sequence. And which one breaks first depends on one simple thing: where the economy is still borrowing to survive. So consider 3 scenarios. Scenario 1, the housing-led break. This happens when rates stay high and incomes fail to catch up. Payments remain the barrier. Transactions collapse, and the freeze becomes its own shock because mobility slows and construction cools. Scenario 2, the market-led break. This happens when investors accept that the discount rate is not coming back down quickly. Valuations compress credit, spreads widen, and refinancing becomes a system story, not a single company story. Scenario 3, the job-led break. This is rarer, but when it happens, it's fast. Demand drops, budgets snap shut, and hiring freezes turn into layoffs. Now, you don't need to guess which scenario is right. You can watch which one is forming. Housing-led, mortgage applications and permits weaken first. Market-led, credit spreads and refinancing stress. Job-led, hours worked and hiring freeze language drop quickly. One more quick comment prompt. Which of these scenarios feels most plausible to you right now? Housing-led, market-led, or job-led? Comment one phrase and your reasoning in a single sentence. And here's the simplest rule to keep it practical. In a high-rate world, watch what stops first. Does borrowing stop first? Does investing stop first? Or does hiring stop first? That answer tells you where the break is forming and what tends to follow next. If housing freezes first, the next pressure point is local spending and small business cash flow. If markets reprice first, the next pressure point is corporate investment and confidence. If jobs turn first, the next pressure point is forced selling and rising delinquencies. And notice what this means. Higher for longer isn't a forecast you argue about. It's a condition you measure. The question is not, will rates fall? The question is, can the system refinance itself at these levels without changing behavior? That is where pressure becomes policy and policy becomes lived reality. And once you see that, the story becomes easier to follow. Inhale, Chimi. Now, with those pathways in mind, we can finally answer the question, what breaks first? In most higher rate cycles, the first thing to crack is not jobs. It's the credit-sensitive edges, the places where leverage is high and cash flows are thin. That often means real estate activity, construction, small business financing, speculative investment. Housing tends to show stress early because it is both emotional and mechanical. People love homes, but mortgages are math. So the earliest break is often housing activity, volume, permits, starts, applications. Then comes the market's break, valuations adjusting as high rates persist. Then comes the labor break, hiring freezes and layoffs as the real economy catches up. But there is a catch. Sometimes stocks break first because markets are forward-looking. And sometimes housing holds longer because supply is constrained. That's why the best answer is not a fixed order. The best answer is a sequence of conditions. So here's the practical playbook. If rates stay high, watch housing for the first visible stress. But watch credit for the first dangerous stress, because credit is where stress becomes break. High rates don't just slow growth. They create a maturity wall that has to be rolled over. And refinancing at higher rates is a transfer of income from borrowers to lenders. That transfer shows up as higher payments, higher interest expense, lower profits, lower investment, lower discretionary spending. This is why rates staying high matters more than rates rising. A rise is a shock. A sustained level is a transformation. Because time is what forces refinancing. Time is what turns higher rates into higher costs. Now, return to housing. But with this in mind, the U.S. housing market is unusual because many homeowners are locked in low fixed-rate mortgages. That delays pain, but it doesn't erase it. It relocates it to first-time buyers, renters, builders, and anyone forced to move. So the housing break may not look like a dramatic crash. It may look like affordability paralysis, a market that can't clear and can't move. And that matters because housing is an ecosystem. Realtors, contractors, lenders, renovations, local tax revenue. When housing freezes, the ecosystem loses oxygen. Now, the stock market under high rates often breaks through duration. Long duration assets suffer first. Then credit spreads widen. Then refinancing becomes expensive. Then defaults become plausible. And once defaults become plausible, even healthy firms get repriced because the market becomes defensive. And once the market turns defensive, wealth effects kick in. Spending cools, and eventually, employers notice this is where jobs enter. Because when revenue slows and interest expense rises, payroll becomes the lead. And once layoffs begin, the feedback loop flips. Consumers spend less. Businesses sell less. Layoffs spread. Housing stress increases. Credit stress increases. Now, quick question. When you hear high rates, what do you think breaks first? Housing, stocks, or jobs? Comment one word, housing, stocks, or jobs, and tell me what you're watching. Now let's make the documentary useful. Here are the indicators that reveal breakage early for housing, mortgage applications, new listings, builder sentiment. For markets, credit spreads, earnings, revisions, refinancing calendars. For jobs, job openings, hours worked, and hiring freeze language. Because layoffs are loud, Freezes are silent, and silence is often the first signal. Now, here's the most important idea of the entire documentary. Breaking does not always mean crashing. Sometimes breaking means reorganizing. Housing might not crash, but mobility breaks, people can't move. Stocks might not crash, but leadership breaks, only a few names carry the index. Jobs might not collapse, but wage gains break, purchasing power stalls. In other words, the system can break functionally without breaking spectacularly. And functional breakage can last for years. So if you want the honest answer to what breaks first, it is this. The first thing to break is the illusion that the old world is coming back. The world of zero rates, the world of effortless refinancing. The world where risk is cheap. Once that illusion breaks, behavior changes. And behavior is what ultimately moves housing, stocks, and jobs. So let's close with a clear sequence. If rates stay high, first, housing freezes, volume slows, affordability collapses, construction softens. Second, markets reprice, valuations adjust. Risk becomes expensive. Credit warns you before headlines do. Third, the labor market turns, freezes become layoffs, and the feedback loop hits consumer demand. And the outcome depends on one variable: how long high rates lasts, because time is the multiplier. Time forces refinancing. Time turns stress into defaults. Time turns cautious into desperate. Now, one more question, and this one is the most practical. If you had to track just one indicator in a high rate world, mortgage applications, credit spreads, or job openings, which one would you choose and why? And now the final thought. The 2010s taught the world what cheap money can build. The 2020s are teaching the world what expensive money reveals. It reveals which business models were real, which assets were priced on fantasy, which households were living on margin, which institutions can survive without constant refinancing. So if interest rates stay high, something will break. But the first break will not be a single event. It will be a shift, a sequence of small no's that becomes a new normal. So if you want more documentaries like this, subscribe. Next, we'll go deeper into the hidden mechanics of the rate regime, why bond yields matter more than headlines, how liquidity moves through the system, and what higher for longer really does even after inflation cools. Until then, keep watching the system, not just the charts.